got this big sticker on here reminding me to hit the record button. So let me mute everybody. Well, thanks for joining me this evening. I know that there's a lot of nervousness out there right now, especially this week. There's just a lot of things going on, of course, with COVID and with the elections now less than a week away. So I kind of wanted to talk about how we're positioned from the recent newsletter that I sent out to you, and then the slides that I sent out also, so that you can get a good feel of where we are and kind of address your concerns. First and foremost, I always like to talk about, our strategy is, regardless of the ups and downs of the market, if you only remember one slide, and I'll make this a little bit larger so you can see even here on your computer. If you just remember one slide, I would recommend that you remember this one. This is, we've been through a lot. A lot of you on video here have been with me for 20 years. I founded the company in '97. I'm still in the Marine Corps, and we've certainly been through a lot, and we've done well. And we've been through, two 50% corrections. We had the dot-com bubble in early 2000. We had the 50% correction here during the horrific financial crisis, and we had a horrific oil sell-off, which a lot of people forget. And then we had this COVID-driven 35% stock market decline earlier this year, and a pretty remarkable recovery back too for this year. But most importantly, none of our clients ever had to go back to work. I got a couple emails today, geez, am I going to be able to retire? And the answer is yeah, because I'm still focusing on companies that are going to pay you. If Procter & Gamble has a bad year, let me just pull in Procter & Gamble here just to kind of talk about one company. You know what? Let me do it from. This might be really busy, but I'm just going to pull up Procter & Gamble here so you see PG. So let's say that I didn't shave today, because I don't have to as much, and I'm just not using my Gillette razors as much anymore, or that you are not washing your clothes as much with Tide detergent because we're all in the same pajamas or sweatpants every day. Then Procter & Gamble's earnings are certainly going to get hurt. And you've seen that, right? I mean, back in 2013, Procter & Gamble was making $80 billion a year. Now they're down to $70 billion a year. But what you'll notice too is that Procter & Gamble has cut expenses. So you can see their cost of their revenue has gone down from 39 billion down to 34 billion. So that their profits, they're doing as good a job as they can to continue to maintain their profits, so that they can pay out their dividends. Now, if I went all the way to the bottom here, what you'd notice is that Procter & Gamble's been paying increasing dividends go all the way back to 2001. You see how they were paying 18 cents a share, and then they were paying 21 cents a share, and then 31 cents each quarter. They raised it in 2006. Then they raised it to 48, and then 60, all the way to what they're paying today, 79 cents a share. They just actually in April raised their dividend again. And my son asked me a good question. He said, "Geez, Dad, how could Procter & Gamble raise their dividend if their stock price is down 80%. I said, well, on a day like today, Procter & Gamble, people are panicking. Oh my God, it's the end times. Trump's going to be reelected or Biden's going to be elected, and COVID cases are spiking. So I'm going to sell Procter & Gamble. It's down 3%. But Procter & Gamble is still making, as you can see, $5.23 a share. So if people do shave less, or if they don't use as much Tide detergent in China, regardless of who's elected, then their earnings might get hurt. Maybe it goes down 10%. Maybe it goes down even more. But that's irrespective of the stock price. The stock price is going to fluctuate based upon the fear of the day. But you can see they're paying out $3.16 a share. So we just looked at Procter & Gamble's dividend that they just raised up to 79 cents a share. So if I did 79 cents a quarter times 4, that would be $3.16, which is right what Yahoo has right here. You can see that we highlighted in green here around the red. So they're paying out $3.16. So even if Procter & Gamble's earnings went down horrifically, let's say it went down by 20%, it went down $1.50 a share, and they're only making, let's say, $4 a share, they still have a strong balance sheet and they still have the cash flow to pay that dividend to you. So when people often ask, geez, Jim, are you worried about the price of Procter & Gamble right now? I always say, well, why do you even care? I mean, here's this year's chart of Procter & Gamble. At one point, Procter & Gamble was down 30%. I didn't care. Now, I get paid based upon your portfolio value. So I cared, am I going to be able to pay my staff? Am I going to be able to pay the overhead? My profits go up and down with the stock market. However, yours do not. As long as Procter & Gamble is paying you that dividend, it doesn't matter if Procter & Gamble was still down here. If Procter & Gamble was still down at a price of, I don't know where it was earlier this year. Let's call it $100 instead of it being $137. It wouldn't matter. In fact, at that point, at $100, people might be attracted to Procter & Gamble because it's paying a dividend. It's why I won't invest in companies that are high-flying, sexy stocks that people want to invest in. They're jumping in and out that aren't going to pay you. Because I don't know, as you're taking out regular income to fund your retirements, what's happening is when I have to sell shares when it's down here. Whereas I never have to sell a share of Procter & Gamble. Most of our clients are taking out 4% a year. And under that scenario, I never have to sell any of the 75 stocks that we own or the bonds that we own to fund your income. Now, when you want a little bit more, when things are good and you take out an extra $10,000 to go on a European cruise or something, we could take out a little bit more and I have to sell some stock. But if you stick to the 4% a year, everything's going to be fine. We're not having to sell any shares of Procter & Gamble. This is a very boring way to manage money. But to go back to the slide, I said this is the only one that matters. This is how I've managed assets for the past 2 decades and what's kept our clients through some horrific time periods. We're not trying to time the market. We're investing longer term. We're collecting income. If you're like me, I'm not planning on retiring for probably forever, but I don't know, maybe 30 years from now when I'm 80, I won't want to die with my boots on, and I'm not reinvesting the dividends. Now, what I'm doing is this. So for my portfolio, if you don't need income, is reinvesting the dividends. So most of our clients on this slide are showing you if a client's taking out 4% a year, they still have more than $1 million they invested 20-something years ago. If they reinvested the dividends, they have more, but you're just increasing your future income that you could take from your portfolio. Your $1 million is worth more down the road. So that's the one thing I really wanted to just impress upon you right out of the gate, that don't be so concerned about the portfolio value, because a lot of times people get anchored in at what their portfolio value is. Let's say it's $1 million and it goes down to 900,000 and they're like, oh my God, the sky's falling. Trump's going to be reelected. Biden's going to be elected. COVID. It doesn't matter. Procter & Gamble is going to pay their dividend to you under most scenarios. And I've restructured the portfolio looking ahead, which I'll talk about later, of what the new COVID world looks like. Now, I'm not saying that who's elected doesn't matter. Certain industries do much better under Democratic regimes. Other industries do better under Republican regimes. Taxes certainly change under both regimes. And we'll kind of talk about those scenarios too later. I told you I'll leave politics till the end because I don't want to lose you or get everybody mad early. I'm going to unmute everybody here quickly and just see if you have any questions so far. Hope I just unmuted everybody. Does anybody want to throw out a quick question?
Hey, Jim, this is John over in Youngsville. Quick question. The stock market seems to always be looking forward or looking in the future, and they've really, this year has been based not on the immediate next quarter, but it seems to be on the next 6 months to a year. So when I see something like this, that rule is still in place, because if that rule is still in place, they're looking at the first 2 quarters of 2021 being a little bit negative for the markets. What's your thoughts?
Yeah, I mean, theoretically, when we buy a stock, we're paying 10 to 15 times future earnings for that company. Theoretically, when you buy a stock, you're thinking ahead 10 to 15 years into the future. I mean, I'm in the process of doing a strategic plan for my company that has a 25-year plan, and God willing, I make it out to age 76. But it's a 25-year plan, right? And so, how is Altrius going to do this quarter or next quarter? I can't tell you, because the stock market's going to either take profits away from me or give profits to me in the short term, because it's more of a weighing machine. The market's just looking at and going, I'm uncertain right now, I'm going to sell, or I'm feeling optimistic right now, I'm going to buy. Longer term, stock prices follow earnings. So you'll see, prices of a stock will follow the earnings of the company over time. And traders that you see on television all the time are always talking about the short term, right? When I'm on Fox Business News, they're like, what do you think the market's going to do next week or next quarter? And they don't want the answer that I always give, which is, I have no idea. They want an answer. So I'll say, well, if you're going to ask me, I think this is going to happen possibly in the short term, but it doesn't really matter what I think in the short term, because life's what happens when you're making plans along the way, and you really need to think longer term when you're investing in stock and not worry so much about what's going to happen quarter to quarter, because businesses, just like I'm making a 25-year plan for Altrius right now, businesses are trying to think 5, 10 years into the future of where they're going strategically and where they want to invest and where they want to build plants. And politicians, of course, always make that difficult to do. So, I mean, I can't really answer where I think the market's going to go in the short term, other than what's happened this year with this quick rebound is that the market is thinking that we're going to rebound relatively quickly. We're going to get through COVID. And now with some additional COVID spikes around the world and here, the market has started to worry again. And I'll kind of get into COVID a little bit too, from a statistics side. But did I answer your question?
Yes, I believe you did, and I'll save the second half of that question until probably a topic you'll cover a little bit later, which is that great federal fiscal oomph that we might need to get over.
Yeah, I'm gonna talk about that now too. So, does anybody else have any other questions before I unmute everybody here and keep going on? All right, so let me unmute and let me mute everybody here again. And so what's happened this year has been really interesting in that there's only a few stocks that are driving the entire market. Most indexes are down. Our international stocks are down. Small cap stocks are down. And the market as a whole is down if you take out the 5 largest stocks. And these are what I've been calling, I mean, you can call it FANG MAG here, FANMAG, which is effectively Facebook, Amazon, Netflix, Microsoft, Apple, and Alphabet. And of course, we still own Apple. We sold Microsoft a couple of years ago. But these few stocks have gotten even bigger this year. And what I want to impress upon you is that it changes, right? So the big get bigger, but the only company remaining in the top 10 from 20 years ago is Microsoft. That's it. And remember how overvalued Microsoft was back then. It was selling at 100 times earnings, not paying a dividend. We really couldn't own it back then 20 years ago. If you go back to 1980, when Reagan was elected, IBM was the largest company in the S&P 500. AT&T, Exxon, you'll see a lot of energy companies. All these companies are gone. What happens is especially today, so many hedge fund managers, and because there's so much indexing going on today, there is a massive amount of money just continuing to make the big even bigger. Now, we want to avoid these stocks generally. Now, I'm not probably going to sell Apple just yet because it's paying us a decent dividend, but not much left. But the problem with the big getting bigger here, and why we're not investing, is that had you invested in the largest stock throughout every year, you would have lagged the S&P 500 remarkably. I mean, just massively underperformed. But that's what people do. That's what my friends here on Wall Street do. The further I get away from Wall Street, usually the smarter I get. They're always chasing whatever's big. So everybody's talking about Amazon now. And this year with the stay-at-home stocks, they've gotten even bigger. But this kind of shows you why you don't want to chase that. And if I skipped ahead even further down the line here, I have a stock from the investment side, which the slide here, you can see that the S&P 500, almost 25% of it's made up of these 5 stocks, which is just incredible. And the NASDAQ that you hear about, it's almost 50% is made up of those 5 stocks. So why would you even own the NASDAQ? You're basically, you might as well just own these stocks individually. And you may have seen some of these guys in trouble today. Twitter, Google, and Facebook were all in front of Congress because they've come and starting to have monopolistic type of power. So that's an issue. And of course, we're not ever at Altrius going to chase performance. It's just not what we do. We're trying to get you to get back to the income side. And when I do scenario analysis, again, people ask economists, and they could ask me, what do you think the market's going to do? What do you think the economy is going to do? What do we, and I've been at 2% GDP for quite a while. You can go down to 1.8% GDP if Biden's elected. You could keep it at 2.2, 2.3 if Trump's elected, depending on the Congress. It'll move the needle a little bit. But what I look at is a worst case scenario. What if we go into another deep recession into next year? And stocks do horribly during this period. I mean, we could lose 40, 50% in a horrific recession scenario. And none of you want to hear that, but it's the truth. It's possible. Now, again, I think Procter & Gamble will keep paying you your dividend. That's going to be, that's not going to change. My life would have to change because that would be a dramatic, like it was this year, it's a dramatic decrease in revenue. So I always look at the worst case scenario and say, what if that happens? And that's one of the reasons why we have bonds, because in the worst case scenario, high yield bonds, you're basically flat on your money. So that'll hold the portfolio together a little bit better. My base case scenario, or I could say, hey, what about the bull scenario? What about if everything goes rosy? International stocks just do terrifically well, could make 18% a year. U.S. stocks could make 9% a year. Our high yield bonds could make 7%. Of course, investment grade, safe bonds, clients will ask, hey, how about municipal bonds? What do you think about municipal bonds? Or all of you know right now, your interest rates in your banks is 0. And municipal bonds are offering 0. There's just very little return to be made. So there are no safe bonds I could buy you, which is why I'm buying you, and we're buying you, focusing on companies we think will get a 4, 5, 6% return from the high yield junk bonds that we're buying for you. The base case scenario, though, is that stocks do okay. Again, in the short term, no idea, but I think that we can get at least mid to high single-digit returns for stocks and get a decent return from our bond portfolio. And that's how we set the allocation. And then it becomes a bottom-up type scenario. So the question about how do we get out of this recession, it's going to take a while. Regardless of who's president, to get 10 million people back to work is going to take time. It's not going to be easy. just like it wasn't after the financial crisis, which you can see here. This was the financial crisis. It took time. It took, Obama became president in 2008, and it took until 2014, 6 years, for us to recover all of the jobs that were lost during the financial crisis. Now, of course, Democrats and Republicans will argue about how we could have gotten there faster if certain policies changed. But that particular time took 6 years. Do I think it's going to take 6 years to come back this time? Possibly, because there have been structural damages to the economy, right? You look at restaurants. My poor dry cleaner, who was an investment banker in 2008, lost his job, started the dry cleaner. He's Indian. He immigrated for here, was an investment banker with HSBC, started his dry cleaning business, and now nobody's getting their suits or shirts done. And that hurts the retailers all around him. That hurts the real estate landowner who's now got to take half if he doesn't want to lose him as a tenant. It hurts everything in the town, so it has a ripple effect. So I think it's going to take time. It's not going to happen overnight, regardless of who's president. The good news is that this time around, the Fed had a playbook. The Fed said, we're going to go to 0 on interest rates like we did last time, and we're even going to buy corporate bonds. We're going to make sure we're going to flood the system with money. And they did it immediately because they had the playbook from financial crisis. They said, this is what we're going to do. And that immediately gave the market some confidence that, okay, at least we're not going to have a liquidity crisis. And with all that the Fed has done from QE 1, 2, 3, and now, QE 4, 5, with all the Fed has done, we've also had a massive amount of fiscal stimulus. Now, by the way, I'll just answer the inflation question quickly, because a lot of times people say, doesn't this lead to inflation? Well, no, it doesn't, because it didn't lead to inflation during the financial crisis, because it's the old Keynesian pushing on a string model. I could throw all the money in the world in the middle of our virtual table right now and tell you that I'm going to lend it to you, but you're not going to borrow it. You're not going to invest in your business. You're not going to buy another boat. You're not going to buy another house, because everybody's nervous right now. And because of that, that keeps demand low. So the velocity on money that we economists like to talk about is very low. You can see, look at the velocity on money. It's just gone to nothing. I mean, you go back to 1960. We've never had velocity of money this low going back. And I like to look at things very long term. Again, somebody asked me, what do I think the market's going to do in the next month, 2 months, 6 months? No idea. I like to look very, very long term in terms of decades and try to find trends. In this case with COVID, I had to go back to the Spanish flu. I had to go back to 1918. But so when you're looking at the velocity of money, there's no velocity of money. So it's not necessarily going to be inflation just because the Fed's printing money. It could happen down the road, right? And Germans remember this dramatically in World War II, and used marks for fire, and that's about all they were good for. If a country is printing too much and people lose faith in that country's ability to tax, then it can collapse. The good news about America is it would be difficult for us to screw that up. We have the dollar is the world's currency, and it's a real benefit that we have, not to mention the just abounding resources that we have. So the second part of this was the monetary, was the fiscal side, right? We had massive $2.2 trillion was thrown into the system. Many of our clients got the PPP, and that helped get their businesses where they were, and they were able to keep all their employees, or most of them, and this enabled business to continue on. A lot of people got checks. Very angry that Congress couldn't come to an agreement. It was clearly political. I will praise Nancy Pelosi for going along with the Republicans when Republican senators did not want to, and George Bush and Paulson wanted and needed a bailout. But I will beat her up for not at least doing something that the Republicans were willing to do to increase, $600 a month, whatever payments to kind of help the people who are poorest right now who need it. clearly this was destined, and I said this in newsletters, that I didn't think a coronavirus relief package, the second one, was coming for political reasons. Right after the election, we'll see something, because the Republicans and Democrats are going to know, okay, here's the team we got. The Democrats hold the House, the Republicans hold the Senate, or the Democrats hold the Senate, and something's going to be done. Even quite likely, I would say probably in the lame duck session, something will get done. So there'll be another stimulus coming, but it won't happen until obviously after the election. The budgets are ballooning. A lot of fiscal conservatives are concerned about this. I wrote a letter and a blog out to you if anybody's curious. You know, I would. It's basically, you know, is America going broke? And I forgot when here it is right here. I wrote it back in April, because a lot of, and if you're interested in, I would read this blog. You know, is America going broke? Yeah, we could be, but maybe we're not even lending enough. And if you look at it like a realtor, like Donald Trump is looking at it, hey, if you can borrow money at 3%, maybe we're not borrowing enough right now. And if somebody would do a 100-year bond, let's do 100-year bonds. You know, economics is a new science, and we're still learning. So there's a lot of debate here. The problem happens, you know, nobody wants to go back to the Carter years when we had very high deficits. You know, here's 1975, right? So we had closing deficits and budgets. And our debt to GDP was about 30%. And of course, during the Reagan years, we started ballooning deficits, and that was good for the economy in the short term. And there's a lot of debate here, and this is one that often gets into politics. Ultimately comes down to is when other nations lose their faith in America's ability to repay it, that's when you can get in trouble. That's when countries like Venezuela go under, or when Iceland or Ireland or other nations which only had a 30% debt to GDP ratio ran into trouble. So is America on a path here? Eventually, you would hope that the deficits will, you know, start to round out. Obviously, entitlements are a big issue with this. And you can see this has been under both administrations. This is not a, again, if you look at debt to GDP, I actually put in, here's a Democratic president. Nobody wants to go back to the Carter years when we had very low debt to GDP. Reagan started ballooning it, then Bush, and then we had Clinton and Bush, and then Obama, and Obama obviously was dealing with the financial crisis, and now Trump, right? So we've got well over 100% debt to GDP. What is the problematic level here? Again, this is not an issue for us as investors, because capitalism will find an outlet somewhere in the world. This is an issue for us as patriots to argue about, and why I'm not going to spend a lot of time on this. But if you're a young doctor and you make, you know, $500,000 a year, the bank is happy to lend you $1.5 million for a house. And that's a 300% debt to your personal income, to your GDP. So maybe America, just like Japan has been running 200% debt to GDP for decades, maybe America should be borrowing more. I'm not going to take a position one way or another. We just don't know. But again, as investors, this doesn't matter as much. So I wouldn't be concerned about this as investors. You know, be concerned about it as patriots. The trade war, of course, now one of the issues I disagree with Trump on is tariffs, but it's been one of the weapons he's used to try to gain concessions. You can see that's hurt both of us. It's hurt China more. And this issue came up in the debate last week, and it certainly has closed. It certainly has closed the deficit. between the United States and China. But when we let them into the World Trade Organization, then we thought, and I could be as guilty as anyone about this, it's like, okay, maybe if we make them good actors and take them into the world, that'll be good for everybody. And now we're finding, especially in COVID, that both Democrats and Republicans are on the side of, no, we got to bring back our supply lines, especially those that affect our health and especially those that affect our national security. So we're in the process of doing that. Both Democratic senators and Republican senators are working on that issue. Dollar might be overvalued, but we're the best looking guy in a really ugly guy dance right now, right? We got negative interest rates around the globe in Switzerland and Germany, and so the dollar may be a little bit overvalued right now. Consumer confidence just swings with the market in the short term, so it's starting to come back a little bit, but you might see it dip down a little bit again. Again, inflation's very low. And the good news is that, and I always show my staff this is during our investor committee meetings, is that if you're getting paid more, you spend more. And so that's effectively what always happens, right? Consumption will go with your income. And right now, the savings rate of Americans, they saved up a lot of the money that was given to them. They spent some, but they saved a lot. So the U.S. savings ratio and Americans' own individual circumstances, since you kind of remember what happened during when people were borrowing too much money. Americans are doing a good job of saving in their own personal households. And we're starting to quickly see things recover. A lot of my clients are going out and buying second homes because of low interest rates. We're seeing vehicle sales recover. Their personal cash flow is good. This is why the poor are getting hurt right now more than anybody. But all of you are doing just as fine as you were last year. Your income hasn't changed one bit because Procter & Gamble keeps paying you that dividend, as I was speaking about earlier. And most importantly, corporate profits are fabulous. 80+% of all the companies that are reporting this week are beating estimates. They're doing terrifically. And, economists have been saying for a long time they can't keep this up at 6% net margins. But we've done it through technology. And yes, it's not up here, 9-10% like it was earlier this year, which it's not really sustainable over long periods of time anyway. But it's come down, but it's still very high. And corporations are doing what they need to do to stay profitable. Now that leads to job layoffs though, right? So Schwab and TD Ameritrade, all of us are going to have our TD Ameritrade accounts eventually turned into Schwab accounts. Well, Schwab laid off 1,000 people today, and that's just the beginning. And it laid off 2 financial advisors I know in North Carolina, 2 very good people. And it's sad for them personally, but Schwab's got to maintain their profitability, and they're doing everything they can. When they don't have profits, they have to lay people off. And they're 2 smart individuals, and my 2 best friends up here in New Jersey, one in New Jersey, one in Boston, are still laid off. And it's going to be tough in this environment to try to find work. Again, that's why I think it's going to take some time. So I kind of put this slide out here, and again, I'm not Pollyannic about this. It wasn't to say, hey, it doesn't matter who's president, we're all going to be okay. But the market has gone up in Democratic and Republican presidents. And I heard a lot of emails that basically said, yeah, but this time's different, Jim. It could be. It could be different. It could be that the Democratic Party has moved so far to the left that we're moving towards socialism. I don't think so. America is center left. America is center right. We go back and forth. If one party goes too far, its own party usually reins them in. So even if we have a blue wave, which could happen, I suspect that Democrats in Montana, Wyoming, North Carolina, Georgia are going to, Manchin in West Virginia are going to rein in their own party and not let them go too far because their constituents wouldn't want them to do that. Stocks certainly look good compared to bonds because bond yields are 0 right now, right? U.S. Treasuries are yielding nothing. Your bank account, your checking account, savings account, CDs are yielding nothing. We have no alternative than to invest in stocks that are paying us some dividends. And that's why you'll hear people say the market's overvalued. Not really, not compared to bonds, and not our stocks, which are just selling at 15 times earnings. Growth stocks, go back to those few stocks that have driven the market, have just massively outperformed value, which is tough as a Warren Buffett type value investor like me. But this will change again. You'll notice that the last time this happened was during the dot-com bubble, and we're beyond that level now. So I think value stocks are eventually going to come back and outperform growth stocks. Of course, I'm not going to jump on the bandwagon and buy Facebook or Netflix. You know, these crazy overvalued. We do own Apple still. Same thing with international. International stocks, which have done horribly this year, have been massively outperformed. Look at this. Since 2013, it's been all U.S. and the globe has not done well. Yeah, but people forget. I mean, international stocks, it goes through periods where international outperforms. So Nestle and Unilever and GlaxoSmithKline and these great companies, Bayer, that we own, may very well outperform U.S. stocks over the decade to come. And these trends are usually quite long. Again, P/E ratios, international stocks are just much cheaper right now than U.S. stocks. And treasury yields are at all-time lows. We're at zero. There's just nothing right now. I can't buy anything safe for you to get you a 5% rate of return. It just doesn't exist. You know, it's when you're in the fight, like when you're in the heat of the battle, it's very tough. Even looking at my career here, 23 years, and then in 1987, you know, I was graduating from high school. We had the crash, of course, in 87. In 91, we had the savings and loan crisis. I was glad I had a government job, you know, as a second lieutenant, flying airplanes in the Marine Corps. We've been through so much the past 2 decades plus, but we've survived it because I've invested in companies that grow their earnings slowly over time and that continue to pay you. You know, to go back to that original slide, the only slide that I really wanted you to remember. And it's really easy to get caught up in like what's happening very short term. Like I kind of show that here in this slide, that when you look at this was a 34% correction that we had this year, and then we had a 39% stock market pitchback. I mean, every time we've had one of these, we had a 49% correction in 2000 during the dot-com bubble, and that was horrific. And then you and I went through another 57% stock market correction during the financial crisis, which was horrible. But we survived it. And the stock market returns after those periods of time, I don't know, you know, that's a big question mark. What's the market going to do from here? I don't know. But I do know that while I like to look at things short, that these are normal. 21% correction in 57, 28% correction, 22, 36. 48, you remember, I mean, 1973, my dad got licensed. He was still a barber, started selling securities and insurance in 1973. The 73, 74 correction was horrific. And we had stagflation during the 70s, but we survived it. And America came back, and capitalism, you know, continued to grow stock prices if you didn't panic. So I just kind of wanted to give some perspective there that we'll come out of this. And how are we positioned right now? Well, you know, we're positioned still, of course, in more. I've been buying stocks all year this year. We've been buying more stocks because our bonds are getting paid back. We keep getting paid back early. I hate losing that nice 6%, you know, interest from a bond. Love getting paid back. Hate when a company goes bankrupt on me, like JCPenney or Hertz. But I like getting paid back, but I hate now. I go, well, now what do I do with that cash that just came due? You know, we had another $1 million coming out. Now, how do I redeploy that? And what I've been doing is finding plenty of stocks, whether it's a company like Ryder, you know, a moving company recently, or 3M or others that I've been able to buy this year that I haven't been able to buy in years, that are paying you nice dividends. So focusing a lot on international companies. You know, the target is 45 stocks at 1% each for most of our clients, including me. We have 20 international stocks. You can see these percentages are a little bit higher because we've had appreciation for a lot of the stocks we bought. And then we're at about 28%. And we've had more cash this year because we keep getting cash that we have to redeploy into bonds or stocks. But longer term, I'm cautiously optimistic about, you know, where we're going to be and how I'm positioning the portfolio. And, you know, to show you the actual stocks, and you see this, the nice thing about our portfolio is that it's just fully transparent. It's just right there for you to see. So if I pulled up, I'm invested in the same stocks and bonds that you are. And, you know, here's just a sampling, and I'll make it larger here so you can see all the stocks we own. As it crunches this, you know, there's 3M and AbbVie. 3M's paying us 3.5%. AbbVie's paying us almost 6%. Philip Morris 9%. When you look at all the companies we own, the 45 stocks I bought, Walgreens and VF Corp, which we recently purchased, we're yielding almost 4% in dividends. And again, if the stock prices go down, I mean, take Qualcomm. I mean, Qualcomm's been a great stock for us, right? So you can see we paid $60 for it. It's up to $125. We've doubled our money in Qualcomm. But I wouldn't care if Qualcomm was still $60. I wouldn't care if it was $40. I just would be buying more shares while it's down, because the dividend yield has been continually, the dividends have been continually growing for us. The actual cash that we're getting paid hasn't changed to you. And it's the same for our international stocks. If you look at Nestle and Dannon Foods and Diageo, which, you know, is Tanqueray, Johnny Walker Scotch, and Smirnoff Vodka and Guinness beer, you know, that's paying us a 3% dividend yield. And Novartis and Prudential, the insurance company in Britain, Sanofi, Siemens. If we looked at all of our 20 international stocks, you could see it's paying right at around 4%. And that's not going to change. If I showed you Altrius's portfolio, let me show you our 401k, just in case you don't believe me. This is my retirement. Is invested side by side you. And I own, so we have about $1 million or so. And again, I'm not planning on retirement, but this is Rita's retirement. This is my retirement. I see Rita on the call here. I keep teasing Rita that I'm going to try to lose all her money so she can never retire from Altrius. But you can see I'm invested in the same companies you are. I own exactly what you own. And, you know, I don't know if Hanes brand underwear is going to be up or down. It's been one of our best performers this year. People are still, maybe they're buying more underwear or staying at home. I don't know. You know, great North Carolina company there. But I do know that Hanes is going to most likely continue to pay us that nice $736. Now, I don't need the $736 right now. So if this was my retirement, if I said, all right, I'm done, I'm selling Altrius, and I'm running off to Montana to my cabin, and I'm just going to ski the rest of my life, I could take the $1.3 million and put it and make $62,000 a year and call it a day. That I can pretty much count on. I mean, Goodyear Tire could go bankrupt on me. Safeway could go bankrupt on me. But as long as they don't, and as long as Procter & Gamble keeps paying, I know I'm going to make that 4.5%. Now, if the $1.3 million in Altrius's retirement account goes down, I'm still going to get paid that $62,000. Now, I see Dr. Kurt there. I mean, he and I are not retired yet. We just keep taking that $62,000 and redeploying and buying more shares of the stocks that are down. This is sometimes I'll get the question, Jim, why are you buying, I don't know, B&G Foods? B&G Foods was a horrible performer for us for a couple of years. Well, what happened to B&G Foods this year? It's been one of our best performers. And clients kept, you know, it was at $16, and clients said, why are you buying it? Why are you buying it? Why am I buying it? I'm like, why do you care if it's down? It's still paying you a huge dividend of 6%. So if I pulled up B&G Foods here, just to kind of show you a chart of BGS, which is a local New Jersey company here. You know, they do like Green Giant. They sell supermarket stuff. And poor Becky, our trader, you know, has to she'll say things like, Jim, do you want me to keep buying this? Like, we bought it 5 years ago, and you can see B&G Foods was down, 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 down. Jim, why are you buying this? You are the dumbest person on the planet. Yeah, I look pretty dumb. But what's happened about B&G Foods is we kept buying. Our clients' dividends never changed. I'm making less money because that stock price is down, but it wasn't impacting you, not one bit. And then look what happened. Boom. Look at year to date. All of a sudden, now this is excruciating to go through 5 years of a market downturn. If I'm a Wall Street analyst, I'm getting fired. I don't care. As long as it's paying you, you're not going to fire me as long as it doesn't change your retirement. Year to date, 5 years, I probably would have been fired. Look at this. Boom. B&G Foods. Huge returns this year. Way outperforming the stock market. Now I look like a genius. Oh, by the way, the total cost was $8,300. You saw that the stock price of B&G Foods is still down significantly. If I do a 5-year chart, look at this. 5-year chart, B&G Foods is still down 25%. If I didn't buy more shares while it was down, I'd still be down 25%. If I just think of it this way, if I put $10,000 in, I would be down today to $7,500. So my clients who are asking me, Jim, why are you buying B&G Foods? Because it's down. I go, why would I want to pay something? Why would I want to pay more? It's like going into Macy's, and why would I want to pay a premium of 20%? I want to buy it when it's 20% off. Now, this is very contrarian. This isn't Wall Street chasing performance. This is what's tough to be a value investor. But look, that $8,300 that I put into B&G Foods is now worth $14,000. So that's a percent return for a stock that's down since we started buying it. That's an incredible, return for the company. But again, if I wanted to retire today, said, all right, I'm going to sell Altrius, I could collect $62,000 a year. If the portfolio went down to $800,000, so what? Still going to collect that $62,000 a year as long as B&G Foods doesn't cut their dividend. And that's what I've been focusing on, is what companies in the post-COVID world or the existing COVID world are going to continue to be able to pay us. And I have a high confidence, what I'd say with the exception of maybe Exxon, I have a high level of confidence that the companies we own, we're not going to be cutting our dividends. All right, I'm going to open up the questions again because my throat hurts.
Okay, so that's what he was anonymous.
Okay, so everybody is unmuted, so go ahead and throw out some questions if you have them.
But anyway, just so you know, Miles Taylor apparently is anonymous.
Somebody's having a private conversation going on.
Used to be funny, but then
there's got to be some questions. Anybody?
Somebody's got some.
All right, I might mute back. All right, so let's talk politics. This is going to be fun. I'm going to mute everybody again. You know what? I'm going to talk COVID first before I go to politics. So I told you I didn't think you'd pay attention if I started talking about politics first. So why I think America's going to recover is, whoops, I didn't mean to put that one out there yet. Let's do this one. So here is the United States, and I'm in the epicenter here. My daughter's had COVID. My son's had COVID. I'm quite certain I had it, and that Annie had it, and our youngest had it around my birthday in February. We all got COVID up here. We got 6 kids in my son's school just got it this week. Hannah had the COVID toes, which is an unusual circumstance. You can Google if you want to get grossed out and see what that looks like. My nephew had it. Everybody's had it up here in New Jersey. We all got COVID. We're spreading it around. And probably getting closer to herd immunity. I don't know where we're at, 20, 30, 40%, who knows. So New York and New Jersey have had and I don't care about COVID cases. The press is just absolutely obsessing on COVID. They're doing this out in Montana too. They're doing everywhere. They're obsessing about the cases. Hospitalizations we could care about because that starts getting more serious. But most importantly, I want to look at deaths because I'm a cold-hearted economist. And if you look at it per capita, New Jersey's the worst. New York's not far behind. And there's no rhyme or reason. Notice that South Dakota has never shut down. And you can see South Dakota is kind of right here in the middle. Now, you could say, oh, but no people live in South Dakota. There's only 5 people per square mile. Well, the same is true for Montana and Wyoming, which are down here too. So they've had a little more shutdowns. Montana's got a Democratic governor, has been a little more conservative, kind of like North Carolina. There's really no rhyme or reason to the shutdowns and the death rates. Some states, especially look up way at the top, Mississippi, Rhode Island's very high, Connecticut, and because the disease was clearly more deadly at the beginning, and we're learning about it, and we're not going to go, even if Biden's elected, I don't think we're going to go to a complete shutdown. We'll probably have pockets popping up, and they'll probably do, that's what the big concern is right now, why the stock market is selling off is because Germany is closing down bars. I went to dinner last night with a friend. It's so sad. New Jersey's only 25%. There were very few people in there. We're spread out. The people who want to go out are going to be getting out. Young people are just out, right? And the good news is it's 99.979% according to the CDC. There's just no death rate for people who are 24 years and younger. The problem is my mom. But my mom lives in the house with me, right? So she's probably in the kitchen, hopefully cooking up something good. And my mom lives with me, and my son comes in, and you're worried about people with pre-existing conditions that we have to keep safe. And we're getting better at that, and we're learning about that. And a lot of us have people we know who've lost people to COVID. But we're getting better at that. And having driven across the country this summer too, I realized that every place is a little bit different, right? Cleveland was different than Chicago, was different from Sioux Falls, different from Billings. And you can see that all the states are doing it a little bit differently, but the good news is we're going to get back to life eventually. And the same is true if you look at the statistics globally. If I did the death rates by nation, Sweden has never shut down. And Sweden has a less death rate per capita than Belgium, than Spain, than Brazil, than Mexico, than the United States. You see Sweden is down here with 575 dead per million people. France is not far behind, and France has had some significant shutdowns. And you can't say like, oh, Sweden's not really like, it's Norway's done better. Sweden has Stockholm. I mean, there's some major cities in Sweden, so it's and it's cold in Sweden too. So we're not going to know for a few years who did it right. Right now, it's a political issue, and I'm not willing to say one way or another either. I have my own idea, but my feeling is that we're going to recover. The Spanish flu, earlier on, I wrote a blog. I said this is not the Black Plague. It's certainly not, right? If you look at, I like to put things in perspective. I have this infographic of the history of plagues and pandemics, and when you look at it in terms of size, there's the Black Plague. So it wasn't much of a stretch for me to say this isn't going to be this Black Plague, and I didn't think it was going to be the Spanish flu either. I was a little worried, but when you look at COVID, we've lost 200,000 and something people. It's significant, but we're here. It's not even close, right, to other major pandemics that we had. It's not even close to AIDS when you think of how many people have died, which we're finally learning about. The good thing is that it seems that scientists are able to break the code on COVID where we can get an effective vaccine into next year, and this herd immunity helps. Where AIDS, we still haven't found a cure for it, We have therapeutics that are working. But, you know, when you look at this from a standpoint of how big a problem it is, I mean, we lose 150,000 people a year to accidents. We still drive, right? We lose 600,000 people a year to cancer. We lose 600,000 people a year to heart disease. You know, and keeping things in perspective, it's just bombarding the news with COVID. I think in the grand scheme of things, it's horrible if I lose my mother or if I die. Very horrible for you because you would lose, you know, a portfolio manager. But, you know, in the grand scheme of things, we're going to get through this. And remember, after the Spanish flu, which was quite large, I mean, the Spanish flu was big, 40 or 50 million people dead globally. We had the roaring 20s. So we came back relatively nicely. So I like to look at things, again, as a cold-hearted economist, look at what's going on. You know, Italy, why does Italy have, which is shut down, massive shutdowns, where you get arrested and fined if you came out of your rooms? Why do they have more deaths than Sweden, which never shut down? You know, and I think that politicians, after this election, regardless of who's elected, we're going to start being able to think more clearly and let scientists make better decisions about, you know, how we should go about life and balance. Again, you know, as somebody who is close to being a priest 3 times in my life, I get the caring tribe. I understand it in the community. And as a former Marine and somebody who loves the West, I love the freedom tribe too. And you're always trying to balance those two things, right? Freedom versus the community and the good of the community. And we have to do that, and we will get there. It's like, okay, for those of you, for me and my best friend who wanted to go out and have dinner, we hadn't seen each other, let us go have dinner. For that waiter who wants to go out and raise his job, and I gave him a gigantic tip because I hadn't seen him in so long and I feel so horrible, let him go out. If he's concerned, if he has pre-existing conditions, let him stay home and find another job maybe that'll allow him to stay home. So we're going to get through this. And that's how I'm positioning our portfolios and why we can't get too wrapped around on what's happening right now. All right, let's talk about politics. Let me talk about the Senate first, because the Senate is just as important, if not more important. So you in North Carolina, and there's a lot of you on the call, have a really big, important election. So what I did here, the Senate is up for grabs. And there's a lot of political things that may happen, you know, packing the courts and Puerto Rico becoming a state, and all kinds of things that, you know, politicians do to try to gain more power. Ultimately, it's going to come down to 3 states, North Carolina, Iowa, and Montana, for whether or not the Republicans hold the Senate. Georgia's got this weird thing going on because Collins is running against Leffler. So that's going to be January, where everybody's going to descend on Georgia if it's 50-50 tied. North Carolina is a really fascinating race. Tom Tillis, I had lunch with him about 1.5 years ago up here in New York. Very intelligent guy, very nice, but he's like a troll. He looks like a troll, right? He's not that handsome, and Cal Cunningham's this handsome guy, and he was getting all of the, you know, all of the rave, and it's going to be a very, very tight race in North Carolina. I don't know who's going to win that race, but it's a very important race to see which way the Senate tips. In this one, you can see I've given Maine away, where Susan Collins, I think, may lose it. Colorado, Cory Gardner, very nice guy, but I think he's going to lose because the Democrats have broken the code. What they say is, let's run a popular Democratic governor against a senator. This happened to my friend Todd Young in Indiana. Todd was in the Marines with me. We were at the Naval Academy together. Todd was way in the lead, and then they brought Evan Bayh in. And Evan Bayh is like Jesus in Indiana, right? His dad was governor. Evan Bayh was governor. He was senator. He was on Obama's ticket. I really thought Bayh was going to get it over Biden. And when Todd was running against Bayh, I thought, Todd's done, you know. And again, listen, I'm friends with Cory Booker too here in New Jersey. You can see I got Cory here, win in New Jersey. And by the way, Cory and Todd are friendly toward one another. There are plenty of senators who are friendly towards one another that you don't often see on TV where they're screaming at one another. There are some people that do get along and are good people still, even though I may not agree with their particular positions. But these, I've given away the astronaut here might beat McSally in Arizona. Arizona's going to be funny. So, you know, again, I'm not so concerned about which way these scales tip from an investment standpoint, but I know that this is what you're concerned about. So I thought I'd talk about politics, the thing you're not supposed to talk about. And it's going to come down to these three races. Montana is running against the popular Democratic governor, Bullock, where Steve Daines is running against that. And Joni Ernst in Iowa is running to hold her seat. And ultimately, it's going to come down to those three states. And it could go either way. Nobody knows which way this thing's going to go. And what's funny is it's very tough for a Republican to win the White House because, as you can see here, Trump, you could go to sleep at 9 o'clock when they report Florida. If Trump loses Florida, it's over. You could just turn the lights out. There's just mathematically, it'd just be near impossible for him to win. So as a Republican, you got to hold Texas, you got to hold Florida, you got to win the whole South here, you got to win Ohio, you got to win all these states. Now that, especially that Virginia is blue, to get to 270, if you can see here with this map, I've got it at 247 to Trump and 223 electors for Biden, assuming that this happens. Again, if Trump loses Florida, that'll tell you where the night's going. It's going to be a blue wave, and it's over. But assuming he holds North Carolina, South Carolina, Texas, and Florida, it's going to come down to these four states and Arizona. And I have no idea where, these states are going to go. Pennsylvania, we may not find out for a month or two later. Who knows? And I hope not, because that'll be a drag on the market. Hopefully, if Pennsylvania is still being contested, that one of the candidates has won Michigan and Wisconsin. By the way, Jesse James, who's a tremendous candidate, West Point grad, terrific guy, is giving a run in Michigan to Peters. So that would be a coup for the Republicans to steal Michigan. So Michigan's kind of fascinating right now. Same thing with Minnesota. Minnesota's got some fascinating things going on. So during the election, watch these states here as they come in, and that'll tell you probably who's going to win. But again, I've kind of given Nevada and Colorado still, which have become purple states now, to blue states, kind of like Virginia went years ago to more Democratic. And that'll give us an idea who's going to win the presidency. Again, this is just because I know you're really concerned. But even if we have a blue wave, it might keep GDP down. We might move. We're going to go to higher taxes. Companies will do what they need to do to keep profits higher. But don't be fearful that it's the end times. It's not. I've doubled your money during the Obama administration, where so many of my clients were very concerned during the Obama. I mean, if I go back to our slide here, the one I told you, the only one I want you to remember, and people were really concerned. You can see here's Obama was elected in 2008. Here's the financial crisis, right? And it was horrific, but we did just fine, And then Trump was elected in 2016. Right here, kind of the market was turning down. And then here's those last, 4 years. But this is the Obama 8 years. We did just fine. So, don't get too concerned. I don't want you to worry too much. Whatever results, we've got Democrats and Republicans on this call. And right now it's very heightened, but I would go to the one slide that I kind of showed earlier where it's like, listen, the market has done fine under both Democrats and Republicans, and we're going to be all right. So with that, I'm going to open it up again for questions. Everybody can yell at me since I talked about politics now. That's why I wanted to save it to the end.
That's where we're at.
Everybody's unmuted. Any other questions?
We've got you and the mayor's